There's a home near our office here in San Diego listed at just under $1.65 million. To buy it, you'd pay almost $5,000 more every single month than it would cost to rent the exact same home. Not $5,000 total, $5,000 more every month just to own instead of rent. And that gap might be the most important number in real estate right now. More important than the price tag, more important than rates. So before you make what could be the biggest purchase of your life, I want to show you what that gap is really telling you. I'm Justin Kuntz, a certified financial planner and managing director here at Pacific Wealth Management in San Diego. Helping people think through decisions exactly like this one. Rent, buy, or wait is what I do every single day. So let's dig in. Here's the backdrop. The slowdown in residential real estate is being felt both nationally and right here in San Diego County. Existing home sales across the country recently fell to just over 4 million, a nearly 30-year low, and well below the long-term average of roughly 5.2 million homes a year. That's not a small dip. That's one of the quietest housing markets in a generation. And here's why that should matter to you, even if you're not buying or selling right now. Housing isn't just a small corner of the economy. The real estate sector contributes somewhere around 15 to 18% of total GDP, and the ripple effects reach almost everywhere. Mortgage lending, construction, insurance, furniture, appliances, moving, renovations, even local tax revenue. So when home sales slow down this much, that slowdown usually spreads into the broader economy in many ways. But here's the weird part. It mostly hasn't yet. Even with that slowdown, the broader economy held up. GDP still grew around 2.1%, and housing may have been a headwind, but just not a strong enough one to knock the whole economy off track. That resilience may be exactly why this slowdown hasn't gotten the attention that you'd expect. If the rest of the economy were weak, a nearly 30-year low in home sales would be front-page news. Instead, it's happening quietly in the background. So let's pull it into the foreground, because the details change everything about that $5,000 gap. Let's look at what the local numbers are telling us, because San Diego County is a perfect example of how unusual this market really is. And start with inventory. The number of homes for sale has climbed a lot from the ultra-tight levels of the low-rate COVID era. There are simply more homes on the market right now. But, and this matters, it's still not at a level that points to a collapsing market. More supply, yes, but a flood, not necessarily. Now, how long are homes taking to sell? Detached homes are taking around 35 days and attached homes nearly 41. Both are slower than at any point in the last 5 years. And that usually means that buyers have a little bit more leverage than they did during the frenzy. But slower doesn't necessarily mean dead. Demand hasn't disappeared, it's just gotten more patient. This chart on pricing often surprises many people. Even with higher rates and far fewer sales, average detached prices were still up 6.1% year over year as of April of this year, 2026. And attached prices were down only 1.2%. Think about that. Activity slowed dramatically and prices barely flinched. That's the central tension of this whole market. Less activity, but prices that just won't break. Months of supply tells the same story. Detached homes had about 2.3 months of supply. Attached homes, 3.6. Higher than the ultra-tight market of a few years ago, but still not the kind of oversupply that triggers major price declines. And then there's affordability, which is really the heart of all this. The affordability index measures whether a median household income is enough to qualify for a median-priced home, and the higher the better. Recently, it sat around 40 for detached homes and 65 for attached. Those are low readings, and that low affordability is the thread connecting everything else that we're seeing here. So what's actually driving all this? Well, it's one word: affordability. Buyers are wrestling with two things at once: higher home prices and mortgage rates that are still elevated compared with the last decade. As I'm recording this, the average 30-year fixed mortgage rate is roughly 6.5% to 6.6%. That's actually below the 2023 peak when rates were briefly pushing about 7.5%. So in that sense, things have actually improved, but it's a completely different world from the 3% mortgages so many homeowners locked in during the low-rate COVID years. And that difference is the whole story. Here's the detail that a lot of people get wrong. You'd think a 30-year mortgage would track the 30-year treasury rate, but it doesn't. It moves much more closely with the 10-year treasury. Why? Because most people don't keep the same mortgage for 30 years. They refinance, they move, they sell, or they pay it off early. And because of that, lenders price mortgages more like intermediate term bonds, closer to that of the 10-year treasury than like true 30-year loans. And recently, the 10-year has been hovering around 4.5 to 4.6%. That move higher has helped keep mortgage rates elevated, and it keeps the pressure squarely on affordability. Then there's the other half of the equation. A lot of existing homeowners are sitting on much lower rates with very little reason to sell unless they actually have to. So we end up with this strange, almost frozen market. Demand is still there, but monthly payment is hard to justify, and supply stays tight because sellers don't want to give up their low rate. That leaves buyers feeling stuck. Sellers also feel stuck, and that's why nothing's moving the way it normally would. What are people proposing to fix this issue? Almost every idea on the table is aimed at the same thing: making the monthly payment easier to absorb rather than directly bringing down home prices. One idea is portable mortgages, letting homeowners take their existing low-rate loan and move it with them when they move. The thinking is that it could unlock inventory from people who feel trapped by their current rate. Another is the 50-year mortgage, stretching a loan out to shrink the monthly payment. And the trade-off there is real. You build equity much more slowly and pay a lot more in interest over the life of the loan. Smaller payment, big long-term cost. Other ideas include government assistance for first-time buyers and loosening the policies that make it hard to build new housing. There's no real perfect fix here. But notice that with all these, they have one thing in common. They're chasing the same underlying problem. The monthly cost of owning is simply too high for a lot of buyers right now. And notice what almost none of them do: actually lower prices. So that brings us right back to that $5,000 gap and to the question that matters most for you. This is the big one. If you're a potential buyer, what should you actually do? Let me be really clear up front. None of this means you should never buy a home. It means you should be honest about the rent versus buy math, because that math has gotten genuinely lopsided lately. A recent San Diego Union Tribune article used Zillow data to compare the full monthly cost of owning against estimated rents, and the gap was really wide. Across California, the typical renter could save about $3,300 a month compared with owning. That's roughly 47% once you factor in the mortgage, property taxes, insurance, maintenance, and other real costs of ownership. San Diego looked pretty similar, a gap of about $3,200 a month, with renters paying about 48% less than the full cost to own. Now, that doesn't necessarily mean that renting is always better. It's not a universal rule, but when owning costs that much more each month, the math clearly favors renting for a lot of households. And the only way to know which side of that line you're on is to run your own numbers. So I wanted to test this locally with a real home, the one that I mentioned at the very start. I pulled Zillow data for the property near our office in Solana Beach and compared the estimated cost to own with the estimated cost to rent something similar. Here's the home. 2 bedrooms, 3 bathrooms, about 1,656 square feet, listed at just under $1.65 million. Zillow's estimated cost to own came in at about $10,613 a month. And the estimated rent for a comparable home, about $5,600 a month. That's a difference of nearly $4,900, almost $5,000 a month. Almost $5,000 more every single month to own instead of rent. And that ownership number isn't just the mortgage. It breaks down into principal and interest of about $7,900, property taxes of about $1,600, home insurance of about $550, and HOA fees of about $540. For context, that assumes a 20% down payment of roughly $330,000 and a loan amount of $1.32 million. And that's a 30-year fixed mortgage. So this isn't the worst case scenario. It's a fairly standard set of assumptions. And the gap is still almost $5,000 a month. Now, whenever I lay this out, a few objections usually come up, and some of them genuinely deserve a real answer. The first is the classic one. Renting is just throwing money away. And I understand why that feels true. But look closely at that ownership number. A huge portion of it isn't building equity at all. It's interest, property taxes, insurance, maintenance, repairs, and closing costs. Those dollars are gone too. On top of that, there's the opportunity cost of the down payment. Tie up several $100,000 in a home and money isn't invested or working anywhere else for you. So if renting saves you thousands of dollars per month, That difference can be invested, saved, or simply kept flexible while the market works through these higher rates. The second objection is fear-based. If I don't buy now, I'll be priced out forever. And yeah, prices have held up stubbornly, but that's a reason to plan carefully, not necessarily to panic. The right time to buy is when that monthly math fits into your actual plan, not when the fear of missing out is making a decision for you. Keep saving, keep your credit strong, and know that the payment truly fits into your life. The third is about rates. What if they only go higher from here? Nobody can reliably time interest rates. Not me, not anybody. But a mortgage isn't permanent. If rates fall later, you can refinance. What you can't easily undo is overcommitting to a payment that strains everything else in your financial life. So let the decision rest on what fits your plan today with clear eyes on the costs, not a forecast nobody can actually make, especially around interest rates. So here's the bottom line. The question worth asking is simple. Have you ever actually run your own number, built from the real cost of the home and the real cost of renting? Or are you working off of a rule of thumb and a sense of what you're supposed to do? For most people, it's never really been actually run. And in this market, when you do run it, renting can turn out to be a genuinely rational financial decision. I'm Justin Kuntz, certified financial planner and managing director here at Pacific Wealth Management in San Diego. And we're a fee-based fiduciary firm, legally required to act in your best interest, not in the interest of any product, commission, or outcome that benefits us. So if you want to run the analysis on what buying versus renting genuinely costs for your situation and how that decision fits into your broader financial plan, reach out through the link in the description below and we'll talk through your numbers. You'll walk away with a clearer picture of the smartest move for you personally. Thanks for watching, and I'll see you in the next video.